Hi, I'm Crystal Stranger. I'm here with Clear.tax to share some of the tax knowledge I have and you need. If you like this video, be sure to subscribe and give us a big thumbs up. Today I'm going to talk briefly about transfer pricing basics for startups. So transfer pricing is this huge subject you can get super far in the weeds with and basically governs everything that big companies do in between their different branches and how that money gets moved abroad and moves to different companies, right? It can also cover payments between, different states when you have companies that are operating in multiple states, right? There can be transfer pricing in states. But basically, what we're referring to and going to talk about here is payments that are between a small US company and a related foreign parent company, sister company, subsidiary. Those are the general ones that we see a lot with startups, and there's a lot of confusion and a lot of challenges, right? So, what is a related company? Generally, there's some kind of complex definitions, so sometimes you need to look at it really specifically. But generally, if the two companies share at least 25% of the same ownership, they're probably going to fall into being some level of related company, right? Um, then we have fair market value. So there's a general definition that the payments made between the companies should be made in some way that reflects a fair market valuation for what those payments would have been made if made to an unrelated third party, right? So say your company in Slovakia is providing services for your US company. Well, the the amount that the Slovakian company charges the US company shouldn't be extremely high, way more than you would charge anybody else if you were selling that. And it shouldn't be extremely low, like a discount you would never offer to any other company, right? But what's within that fair market value range? There can be quite a variety. For larger companies, you typically do a complex transfer pricing study. You look at rates that are across regions, across different industries, and those rates change so dramatically and they change every year. It is just unreasonable for a small company to be able to keep up with that because transfer pricing studies are $20,000, $30,000. They're really expensive. So you don't really need that in early stages. When do you need that? Typically, you need that between 5 million and 10 million of combined revenue between your companies, right? So when your gross revenue amounts get up in that range, definitely before you get to 10 million, because that's when the rate of audit gets much larger in the US. In Europe, I think the amounts can be a little lower there. So that's usually that range that I recommend that in. But in the short term, small companies, what they do need is they need an intercompany services agreement that structures that agreement between the US company and the related company and says, okay, we're going to charge this amount based on this business logic and what the terms of those payments are going to be, when it's going to be paid, what's going to happen if it isn't paid. All of these types of terms and agreements need to be spelled out. They need to be spelled out in writing. They need to be spelled out in writing before you file your tax return, because in order for that to be a contemporaneous agreement, it has to be prepared before the tax return for the year it reflects is filed. So anyway, I hope this helps. It's a complex subject, trying to give you a really understandable, brief introduction to. But if you need help with taxes, please visit us at Clear.tax today. Clear is your tech-forward financial solution for startups and growing companies. Thank you for watching. Please remember to subscribe and give us a big thumbs up.